Hey, it's Stuart. Today I want to talk about currency hedging because there's a lot of written about it, and as investors in international share markets, currency fluctuations can have a big impact on the performance of our investments. Now, the research tells us that over the long run, currency just tends to play out because there's going to be times when the Australian dollar is undervalued, there's going to be times when the Australian dollar is overvalued. And it's really just a point in time measurement. Probably the best analogy is to think about interest rates. You know, if you borrow to invest in property, there's going to be times when interest rates are low, times when interest rates are high, and it all kind of averages out, if you like. But I think that there's really two important questions that we should ask ourselves with respect to currency hedging. The first one is, what are you hoping to achieve with your investment? So for instance, if I think, oh, look, I want to go and buy the S&P 500 index in the US, that's what I'd like to do. Now, what's driving that decision? Is it driven because I think I want to invest in the share market in the US? Or is it driven because of currency decisions or reasons? And most times it's really about getting the underlying exposure. So for most investments, it's really just about investing in the US share market. And that's the main aim of the goal. The second thing to think about is what is my up or downside with respect to currency? Now, the Aussie dollar on average over long periods of time averages around 70 US cents. So if I'm investing and the current exchange rate is say 50 cents, my risk is that over the next couple of years after making that investment, that the Aussie dollar returns to 70 cents. If it does that, it's going to destroy about 40% of the value of my investment. So that's a significant downside as an investor. So even if the share market does really well over that time, the currency change will probably offset any gains, and I'm worse off. Versus if I invest when it's parity, when it's dollar for dollar, for instance, well, the chances are in the long run, it's going to reverts to its mean over the long run, it's going to fall to 70 cents. If it does that, my investments are going to appreciate in value by about 30%. Therefore, there's a lot of upside to me being unhedged. So the way that I view hedging then is really about the decision at the time when you contribute additional capital into your investments. Because that's the risk. If I'm going to put $10,000 into the market today, I want to gain the underlying exposure to the market that I'm investing in. So my example, S&P 500. And depending on where I'm at in terms of where the current exchange rate is relative to 70 cents, which is the long-term average, I want to think about what is my up or downside. And so typically my view is when the currency is trading at 65 cents or less, I will hedge any new investments just to protect that shorter term return, I should say. If I'm investing in, let's say it's trading at above 75 cents, well, I definitely want to be unhedged. And if the Aussie dollar is somewhere between 65 and 75, I'm probably going to go unhedged, but it really depends on the rhetoric at the time and what I think the risks are. And the whole idea is just around new capital. And if I apply this approach over many years of investing, I'm going to end up with some of my portfolios hedged and some of it's going to be unhedged, and I can kind of live with that. So I'm not going to play the currency markets. I'm not going to turn hedging on or off strategically just because I want to play the currency markets, I should say. It's really just about protecting any new capital and protecting the short-term returns on that new capital by considering my hedging risks. So that's my approach. The good thing today is a lot of ETFs offer hedged and unhedged versions. And the other good thing is that the cost associated with hedging, if the hedged versions are slightly more expensive than the unhedged, it's not by very much. So you can really protect yourself from those currency movements without giving rise to a whole heap of cost. Anyway, I just wanted to share those thoughts with hedging because I know there's a lot of information out there, and hopefully that explains it relatively simply. Cheers.